because there's years of pent-up demand, there's all these managed, walled garden capital that kind of wants some Bitcoin. If you were to kind of surprise to the upside in a cycle, I think ETFs are one of the major variables that would probably enable that. Collaborative custody with like one firm holding one key, or multi-institutional collaborative custody. I think these are all things that are really powerful parts of the Bitcoin network. You can split your ownership in multiple locations and make it so that even a major government or a major uh, Ocean's 11 team of hackers would have trouble getting your coins because you have this capability to split things out. You can't multi-sig gold. You can't multi-sig equities. You can't multi-sig real estate. All the ETF is in developer terms, basically the API for the fiat system. It just allows the fiat system to plug into Bitcoin a little bit better than it used to.
This podcast is entertainment, not financial, tax, or legal advice. Views expressed represent statements of the speaker in their individual capacity, do not represent the views of Unchained, and should not be considered investment advice. Speakers often have personal, family, or business connections to Unchained, which may include direct financial benefits. Please see our disclosure at unchained.com/podcast.
Hey everyone, welcome back to the Bitcoin Frontier podcast. This week I have on Lyn Alden. Lyn, welcome.
Happy to be back.
Yes, glad to have you. Let's start off. You gave a presentation at Princeton on broken money, and then you had a discussion with Carolyn Wilkins, who's a Canadian central banker. How did that go? And do you think the academic world will ever take, Bitcoin seriously?
So I think it went well. I appreciated Princeton for making that possible. And before the event, I was there for a number of hours talking to student groups. There's student economics groups, there's student blockchain groups. I had meetings with some of the professors. I met with Carolyn Wilkins. They all went very well, good discussions. Um, and so that was kind of a full day event, which was really useful. And the questions were, there were questions after the event as well, so, like, a book signing, and so that was, like, a whole great thing that Princeton did. Princeton also has, something called the D Center that I've been to a couple times, including their first one, which is they have this kind of it's like a mix between economics and computer science and a couple other areas about applying technology to make things more decentralized, with obviously money being, at the forefront of that. And so they have had a number of events with people. They've had, for example, Alex Gladstein of the Human Rights Foundation. They've had a bunch of other people from the space, also other crypto ecosystems. But it's a university setting that tends to be the norm. So I think that they're one of the universities is actually kind of taking this a little bit more seriously than others. They have upcoming things on decentralized social media that's interesting. And so I think that as a $1 trillion asset now, it does to some extent capture the attention of academics. The bigger it gets, the bigger it becomes part of the social discussion in general, which will include academic circles. But in general, academic circles are slow to change. And if a lot of them will look at things from a top-down perspective. Um, and so I don't think that's the leading area where we're going to see a lot of stuff. I think this is kind of the thing. You just have to build it. You just have to it's be more of a business and user and developer led movement and technology, more so than something that is graced by major institutions. Although when they happen, you should accept it or kind of work with them and see what you can do. There is a book coming out called Resistance Money by Andrew Bailey and others. It's a multi-author book, and that is three philosophy professors, so academic people exploring Bitcoin positively. So there are, and that has an academic press associated with it. It's not a retail book. It's an academic press. And so I think that the larger it gets, the more of these kind of voices you have in the space. It is actually at least part of the conversation, even if it's not necessarily the majority view, which is fine.
What was the general sentiment among like the students and the professors that you were interacting with? Did they have a good grasp on like what makes Bitcoin Bitcoin or what separates Bitcoin from crypto, or were they just generally curious about everything?
Curious about everything. And I think for a lot of people, we're still kind of in the blockchain, not Bitcoin phase of discovery, which is a popular. I use that line because that was a popular sentiment a while ago. It's not quite that now, but basically, um, there's the idea that programmability is a good thing. with not necessarily understanding of the trade-offs, right? So kind of if you approach the space and you're here for a handful of hours, your first thought is, okay, Bitcoin's old tech. These other things can do more. So by default, I should gravitate towards whatever does more or is more scalable and things like that. And it's not an insane thing that if you're here for a little while to explore that. And so that you get questions like, well, why not this? It's more scalable, it's more programmable. But a lot of people don't realize, for example, that Satoshi literally deactivated certain opcodes in early Bitcoin. He literally made Bitcoin simpler on purpose, and that's something that is engineers can get that pretty readily. Um, but it takes time to kind of explain that sometimes simplicity is better and that is actually a feature. And so with Bitcoin, because we optimize mainly for decentralization and security more so than features, um, that's the thing that's like there's a learning arc to that. Like, you find Bitcoin, then you find all this other stuff, and then you kind of eventually, after you explore the space enough, you realize why a really simple proof of work base layer is super important. And so my impression is that a lot of people are still on the earlier part of that exploration, which is fine. But that's generally how I see it. I think that one of the things to emphasize is that the simplicity is a choice. Like, it was a design constraint. It was not like an accident that Bitcoin can't do more. Is a design choice by Satoshi and those who've continued the code since then, and the fact that Bitcoin is purposely hard to change by design, and that's valuable. Analogy I like to use is the U.S. Constitution. So the U.S. Constitution is an amazing document. We can all probably think of ways we could make it better. I'd like to add another 10 Bill of Rights, for example, to give even more freedoms to individuals or clarify and elaborate on certain amendments that seem to often be kind of ignored by laws. I'd like to kind of make it so explicit you can't ignore it, right? I can imagine ways I could make the document better from my perspective. But the sheer fact that it would be easy to change would make it a worse document, even if you could change it for the better, because it means someone else can change it for the worse. So the fact that there's not been an amendment in decades, there's only been like 2 amendments in like 50 years, something like that. Um, that's a feature, even though it can be a frustrating feature. And so I think that through education, people can realize why Bitcoin specifically kind of stands out from the space, but it does take time. And I tend to emphasize Bitcoin and stable coins because kind of outside of Bitcoin, and ironically, I mean, they started on Bitcoin, and they could come back to Bitcoin, but really the only other space that I think we're seeing a lot of kind of utility from is the stablecoin space, which are really just dollars going into a crypto environment, making use of some of these rails in an international context. So for me, it's mainly the Bitcoin stablecoin discussion.
Is there a specific size for Bitcoin in which you think, like, the academic world would really start to, like, question some of their original assumptions? Like, to me, thinking back, like, I thought $1 trillion would be something that would wake them up, but apparently not really. Would gold parity be that level to where they start paying attention? Does it have to go even higher than that for them to really start to pay attention?
So I think that gold parity is kind of a meme that like our space cares about, but that the average person is like, what are you talking about, right? Like they don't know the market cap of gold, they don't know the market cap of Bitcoin, they don't know the relevance of that. If anything, the funny thing is before you hit gold market cap parity, you surpass the U.S. monetary base, right? So if Bitcoin is a bigger right now, it's something like the sixth biggest monetary base, which is base money, not broad money. Obviously, U.S. broad money is way bigger than gold. But if you pass the base money, that's a fascinating talking. Even if you're like number 2 or 3 up from like number 6 right now, whatever the number is, if you're up there with like China and Europe, in terms of like the biggest monetary bases in the world, that's fascinating data point. Um, I think one of the biggest things is one, seeing it not die multiple times. So most of us in the space have looked at the long-term logarithmic chart where you see all the cycles of Bitcoin. You have to keep in mind that most people have not seen that chart, right? That's in our echo chamber, we see that chart all the time. I think you even have that chart behind you with the colors. Like you can kind of see Bitcoin price on it to some
Exactly.
extent. So we've seen that chart and charts like it. Most people have not. They've seen the price rises that occurred within their conception of paying attention to it, which, for example, might have been the 2017 bull run and then might have been the 2021 bull run. So they saw a big bubble and then they saw another big bubble that was bigger. And they often view it in linear chart. So it either looks like a bubble or a broken bubble. And they don't know that there's been prior cycles before that. And so I think people often wake up when they see like the third rise within their span of paying attention to the asset that they've personally seen, like it not die 3 times, for example. I think that's a big kind of signpost. Um, and another one is just that the relevance where the size matters is that when more people hold it, uh, and when it become when lawmakers are talking about it, I mean, certainly the size has caught a lot of their attention for sometimes good, sometimes bad reasons. Um, I think overall, academics will be paying attention to it because it's a larger and larger asset and it's a larger and larger part of the discussion, and it's not considered fringe. So if you write a research paper on it, you're not gonna like be told why you're working on that niche thing, right? It's like, no, I'm working on something that's the size of the US monetary base, for example. That'd be a relevant thing. In general, you don't see academics change their mind very often. Um, it's different than a business context. Normally, kind of people rotate out of the profession, one way or another, and other people rotate in, right? So I don't think it's a surprise that the professors that are working on that resistance money book are on the younger side of professors. I don't know their exact ages, but they're not, they're not gray-haired professors, even though ironically there's plenty of older people that really appreciate Bitcoin, but generally in the academic circles, new ideas or new things tend to come from the younger side of professors. So I think it's a lot of it's just rotating, it's just time. It's, 5, 10, 15 years of some people rotating out, more people rotating in, the asset getting bigger and therefore more normal to talk about, the Overton window shifting over time. That's generally how I approach it. Whereas business stuff, because you have kind of an objective measuring stick of profit, that tends to pivot a little bit sooner than more narrative driven or model driven or intellectually driven types of work.
It makes sense. In your book, Broken Money, what's an insight that you shared within the book that might surprise readers or longtime Bitcoiners that they may not have heard before?
I think, there are probably a couple areas. One would be the kind of how far back credit goes, right? So the common narrative is there's money and then credit came on top of it, whereas, if you actually look at the kind of the long-term history, credit was there from the beginning in various forms.
In this frontier moment, Lynn is discussing how credit has actually been around just as long as commodity money. Lynn discusses the commodity theory of money and credit theory of money in her book, Broken Money. In the book, she talks about how Adam Smith in 1776 discussed the emergence of money as a solution to the barter problem, in which commodity money should be divisible, portable, durable, fungible, and scarce. This ultimately makes a specific commodity the most saleable good, a solution to the barter problem. It's how one tool naturally becomes known as money. In Broken Money, she explains how ray stones, money on the South Pacific island of Yap, have actually been used by both Austrians and MMT economists to explain the emergence of money. Unlike other commodity monies, raystones wouldn't physically move when transacted. In that sense, raystones were a literal ledger system, fairly similar to the credit based monetary system today. In this sense, Bitcoin is not much different, except it's perfectly scarce. Bitcoin is also a public ledger system that could be somewhat compatible with the commodity theory of money and even the credit theory of money. And now back to Lynn.
And how that works. So that's a common thing. I think emphasizing the Hawala system and other proto banking, kind of the development of banking over time, is a key thing that I emphasize more so than other Bitcoin books. And I think probably the number one thing would be the importance of technology on historical money, right? Not just money itself, but banking, how we move money. And so, for example, one of the cases I make is that a lot of times in like Austrian literature, you'll see like you'll see people say that we should stand the gold standard or we should do this or we should do that. Whereas I say that's fine and good, but the reason they've been on the losing side of the argument for a while is because certain technology just shifts incentives, right? So once we could beam around money internationally at the speed of light, gold was now at a permanent disadvantage. It's very easy to be ignored, dropped away, and kind of just sequestered away to just like a savings asset and not really like an actual monetary asset. And so I kind of view that technological determinism as a bigger factor than most people seem to realize. Um, and so I think that specific view of combining history and technology and kind of looking it through that lens is something that I approach a lot more thoroughly or put a lot more emphasis on than other books.
I like it. I do want to talk about the ETFs since the ETFs have been such a hot conversation recently, obviously. What have you seen from your perspective regarding the initial inflow trends and, how did the first month of these ETFs trading, how did it go from your perspective?
So I think the first month or so was, about as expected, which is that you had a lot of rotation out of GBTC, a lot of trapped money, got out of the higher fee, product and got into these lower fee, more reputable products. Um, and it's challenging because if you're in a taxable account, there's actually kind of, maybe reasons not to do that right away. And whereas if you're in a retirement account or other sort of tax advantage account, there's more reasons to do that on day one. And so you saw basically this rotation of a lot of pent up demand to get out of one product into other products. So that was normal. And that kind of, you had net inflows, but not overwhelming the first month. I think that's what's been more interesting and perhaps mildly surprising was stronger interest in like the kind of the week 4, 5, and 6. I don't know exactly how many weeks we're in now because you went from mid January, now we're entering like later February. Kind of we're early mid January is when they came out. Now we're like mid late February, so we're something like 6 weeks in. Um, these last 2 weeks have been more interesting because you've had the GBTC outflows slow down while inflows are still quite strong, and so now you've had better net inflows. Now we could pause again for a little while because my understanding is that there's a handful more big bankruptcy entities that are going to probably have another wave of GBTC rotations. But overall, I think the sustained duration's been interesting, and talking to some of the large institutions and asset managers in the space, um, these things do take a lot of time. There's multi-month review processes among some asset managers before they consider letting a new product into their, mix. There's also, even the large institutions that are, like, issuing these products don't necessarily go to every client on day 1 and say, "Here's this new product." They have kind of a phased rollout, that they do.
With tax day on April 15th, high net worth Bitcoin holders could be leaving a lot of money on the table if they don't have a sound financial plan and tax strategy. Sound Advisory is a leading financial advisory firm for long term Bitcoin holders like yourself. They can help you maximize your Bitcoin wealth while navigating the complexities of the legacy financial system. Don't get killed on taxes. Check out Sound Advisory at thesoundadvisory.com for more information. That's thesoundadvisory.com. Now back to the show.
And so I think that the overall, momentum's good. It's probably a little bit better than I expected, but still generally within the realm of I expected. And overall, I still generally view that this upcoming bull market, if it happens, and it's already been happening arguably, but if this more sustained bull market occurs, my base case is that it was going to occur anyway, if it and that the ETFs are more likely to amplify it, rather than be the cause of it. That basically, once Bitcoin's all-time highs, more people say, "Hey, maybe I should get Bitcoin," and then ETFs are one more vehicle that they now have available to them. There's certain pools of capital that could not buy it before that now can. And so I think overall it's an additive effect more than a causal effect. But so far it's been quite constructive. I also think it's interesting that obviously there's a bunch of different issuers and large institutions are multifaceted, right? There's some people that in the institution that get Bitcoin, some people that don't get Bitcoin. And in most of these major institutions, there are really knowledgeable people on Bitcoin that really get it, and that for years in some cases have been trying to get their colleagues to get it. It's kind of, it's Bitcoiners have kind of infiltrated a lot of major institutions, and they often have a voice in there, and it's usually just a minority voice. And these products kind of, elevate that voice a little bit.
Yeah, I was also somewhat surprised to see the inflows really starting to tick up like multiple weeks after, given the GBTC outflows started to stop. You brought up how you think the ETFs will amplify a potential bull run, not necessarily be the cause. How much do you think that the fact that these ETFs exist, like amplify by how much? Like, I guess in comparison to if they had not exist, how much can they really affect and amplify the bull run?
I think that's really hard to say, but I think that if so as Bitcoin gets to higher layers, it has to reach into more types of capital, right? So if there's just like say 30 trillion dollars in managed assets that just can't touch Bitcoin and it's in these walled gardens, then that kind of limits what Bitcoin reach in a given cycle, right? Because those assets are not going to come out of those walled gardens. And so to the extent that Bitcoin can penetrate into those walled gardens, that's relevant. Um, and so I hesitate to put a number on it, but it's just the answer is higher, right? It's just higher than it would otherwise be. And if there's anything, so Bitcoin has so far had a history of diminishing returns, still high returns, but diminishing returns. That every cycle, if you take the cycle high and do a multiple of the prior cycle high, or you do say the cycle low to the cycle high. There's a couple different ways to measure how big a cycle is, but according to most of them, you've had diminishing returns. One of the surprising things, or kind of a consensus breaker, would be if you get a cycle that is higher than a prior cycle. That's never really happened before, and I'm still agnostic if that's going to happen this time or not. But one of the if it does happen, one of the factors that I think would be relevant for making it happen is the ETFs. If there's something that helps us surprise to the upside, I think last cycle surprised most people to the downside. Like the high was not quite as high as some people were hoping. The low was lower than people were hoping, even though it was a much higher high and a much higher low than the cycle before it. But if you were to kind of surprise to the upside in a cycle, I think ETFs are one of the major variables that would probably enable that.
Yeah, on that topic of the kind of muted high during the last bull market, I know some people have suggested that FTX and other entities maybe selling paper Bitcoin played a role in not having that typical blow off top that we might see. Do you agree with that or do you disagree with that?
I think that's part of it. Yeah, there was is I mean, it's well known now that there was some rehypothecation. And that's I mean, that's a threat to any financial asset. Um, and so that's, we like FTX was something like 1.8 billion, naked short Bitcoin, um, dollars worth. And there were other entities in a similar boat. So I do think that was a muting factor. I think a potentially other muting factor was that across multiple asset classes, there was extreme speculation, right? So equities were across the board reaching like speculative mania, especially like unprofitable tech stocks and meme stocks. We all knew that cycle. And then that, of course, extended into the altcoin realm, which happens in every cycle so far. But that was a particularly noisy segment. And so I think if anything, the proliferation of altcoins probably muted Bitcoin's high more so than some of these specific entities. But then it all kind of plays a role together.
Yeah, I guess FTX to some extent was kind of selling people's Bitcoin and buying altcoins, so that didn't help at all.
Yeah.
Back on the ETF, from your perspective, is there any risk at all with the ETFs, like capturing Bitcoin, or is it an issue if a significant percentage of coins end up in Bitcoin ETFs?
So I think that would have been more of an issue maybe 10 years ago, like when the Winklevoss twins originally proposed a Bitcoin ETF, which was a good thing. I mean, it was made sense for them to do so. They were early on this whole kind of asset. But if that had happened, you can imagine a case where a lot of the Bitcoins wound up in ETFs. Fortunately now Bitcoin's had 15 years to kind of distribute. And so it's pretty hard to get the genie back in the bottle and pull a lot of those coins back into very centralized custody. Um, using GBTC, there was already like 600,000 coins, over 600,000 coins in not an ETF, but a trust, basically an ETF for this discussion. And so if you kind of go up to 700,000, 800,000, 900,000, a million, you're still talking about 5% of coins. Um, and so and the more you get, the more that likely drives price. Um, and that makes it harder to get a bigger share of the network. You can get a more dollar value, but the network value is increasing, and so your ability to keep getting a higher percentage of the network into ETFs is, I think, somewhat limited. So I think we'll see a period where that number goes up, that percentage goes up, because there's years of pent up demand that you know there's all these managed walled garden capital that kind of wants some Bitcoin. So I think when that demand's met, it starts to kind of slow down. The major threat. because it's a proof of work network rather than a proof of stake network, it's not so much about transaction censorship and things like that. The main thing would be kind of determining what side wins in like a hard fork or major owners have a kind of an influence on that sort of thing. There's an economic push that happens. So it's not that the threat is zero, but instead I would say basically there already were several 100,000 coins in these centralized entities. Even, when you take in other things like Coinbase, there's more than that, but there's still the minority. So it's a large minority of coins are in these kind of big centralized honeypots, and that this might slightly increase them, but not enough. Like if you weren't worried about 15% of coins being held in big institutions, 20% is not going to be the game changer, most likely, right? Or 600,000 coins in ETF specifically going up to a million or billion point two, right? That's not what changes things. So overall, I think that risk is somewhat overblown, even though I am glad that people are talking about it. And the point that I've made is, I think the ETFs, it's understandable that they're getting disproportionate coverage right now because they're one of the major new catalysts for demand and therefore price. In terms of importance, I think it's really important to make technologies or enable kind of communities around the world to use Bitcoin. So I've made the point that, for example, these little Bitcoin hubs around the world are really important, right? So Bitcoin Beach was an early example, but now you have Bitcoin Jungle, Bitcoin Akasi. You have conferences popping up in India and Africa and South Korea, and you have all these different hubs around the world, these different communities, and some of them are making their own wallets, so they're trying to localize some of their custody, right? Because the worst case scenario would be, you know, all these communities around the world all having coins in Binance, for example, right? One giant international honeypot that is seizable, hackable. You want coins to be more distributed, and you want like you don't want BlackRock or other large institutions being like your top-down marketing funnel for Bitcoin. You want on the ground grassroots, um, people understanding Bitcoin and sharing to others why they like Bitcoin and making Bitcoin more usable for them, answering their questions, right? Making it easier to onboard. That's something that has to happen at the grassroots level. And over the past few years, it has been happening. And I think any technology or any amplification of what they're doing is probably the single most important thing relative, compared to the ETFs. But I don't really view the ETFs as a threat either. I think if Bitcoin has a problem from an ETF, then Bitcoin was never really worth caring about to begin with.
Yeah, it's a good point. And if, a million or 2 million coins does get sucked into the ETF somehow, it probably means the price of Bitcoin is up pretty significantly from where it is
Yeah,
today.
which makes the percentage hard. And I also think that some of the like the no coin or TradFi arguments are Bitcoin is no longer like cypherpunk money because there's ETFs on it, right? But that's a silly argument because Bitcoin didn't decide to have ETFs on it. It's not like the Bitcoin committee council got together and decided we're gonna have ETFs now. There's no such thing as a Bitcoin committee or a Bitcoin council. Bitcoin is just an open source protocol. And now TradFi has decided to put structures on top of part of it to bring some of it into its own system. All the ETF is in developer terms, basically an API for the fiat system. It just allows the fiat system to plug into Bitcoin a little bit better than it used to. That's all that these do. It's an upgrade to the TradFi system, not an upgrade to Bitcoin, even though it moves Bitcoin price more than it moves TradFi price this cycle. Um, and so that doesn't change the fact that there's other uses of Bitcoin that are more cypherpunk, right? If our parents have Bitcoin in an ETF, right, that's not particularly cypherpunk, but they don't really have a cypherpunk need right now. So they're like fine with that. Whereas I think that, kind of the ongoing battleground will probably be around privacy. So Bitcoin has kind of won the war for like existence. Um, and I actually think it's starting to turn the tide about the whole energy debate. There's a lot of really good pushback on the whole Bitcoin's going to consume all the world energy and boil our oceans narrative. And there's been a lot of pushback on that, both in terms of narrative and in terms of grid balancing or the understanding that it mostly uses stranded energy and it's incentivized to use the cheapest energy in the world, which is mostly energy not being used, right? That is slowly getting into the media, into academia. But I think the battle that's still far from being won is privacy. Basically, that there's going to be lawmakers cracking down on private use while the ETFs exist, and that's the cypherpunk like frontier. That's the part that is still, you know, that developers are still working on, that users are still exploring, that people are pushing back on laws for. And I think that's the area where there's going to be some battles ahead.
I agree with that. What are your general thoughts on the concept of collaborative custody, both for individuals or high net worth individuals and enterprises as well, in comparison, I guess, to the ETF?
Well, so I think collaborative custody, specifically multi-sig more generally, it's one of the features that only assets like this can do that prior assets couldn't do. You can't multi-sig gold. You can't multi-sig equities. You can't multi-sig real estate. So the fact that it's like Harry Potter, it's like Voldemort with his Horcruxes, right? He's like split. You had to go around and go on an adventure to like destroy all seven of his Horcruxes. I think that's the number before you could kill Voldemort. And Bitcoin, because with multisig, you have that capability that only fictional supervillains had in the past, which is that you can split your ownership in multiple locations and make it so that even a major government or a major uh, Ocean's 11 team of hackers would have trouble getting your coins because you have this capability to split things out. And of course, depending on your size, you can do that to different degrees. You can have a simple 2 of 3, you can have a 3 of 5, you can have a crazy setup that's, like, resistant to the Ocean's 11 team, you can do whatever you want, and I think that's a really powerful feature of the network, that you can have custody while minimizing your risks of, messing up coins yourself, but you're still not relying on single sig custody, and so either collaborative custody with, like, one firm holding one key, or multi-institutional collaborative custody. I think these are all things that are really powerful parts of the Bitcoin network and what would help differentiate it from some other TradFi assets. So yeah, I'm very bullish on collaborative custody. I do think that if you're a fairly sizable holder of Bitcoin, it's something you should consider. Like I definitely don't recommend the ETF for most people. Like the ETF's good if you have a walled garden capital of some sort. If you have a retirement account that's kind of where it is, it's not going to move, or you have managed assets, or there's certain that the fact that they can now get price exposure is a good thing. But if someone has the option, and even as the possibility that they might want to use Bitcoin for their monetary purposes in the future, not even the expectation, but just the possibility that they might, then they probably should not have it in the ETF wrapper, and instead should custody themselves or do multi-sig, collaborative custody type of setups, because I think those are really making use of it without most of the downsides, because the other risk is that more people like lose coins than, you know, um, get them confiscated or stolen from, right? And so collaborative custody is really cool because it's one of the few things that benefits from both. Like it benefits both of those scenarios. It says, okay, it's harder to mess up and lose your coins, and it's also harder to have them seized by some entity.
So I guess you buy into the idea that key agents or keys can be geographically distributed among, potentially even like different political jurisdictions if you're a large enough entity holding a significant amount of Bitcoin, and that might offer some benefit.
Yeah, I think so. I mean, in the intermediate term, there's challenges because the reach of some major governments can extend into other governments and basically say you need to hand over that key too, and they'll comply. Um, so, for example, if you're an American, you try to open a bank account in other countries, a lot of other countries will comply with U.S. like laws and like kind of report that to the U.S. government and stuff like that. So that's still going to be the case with things like Bitcoin keys. But overall, I think it's really important. And also, the cool thing is it allows you to do it yourself more. Even if you just have it 2 of 3 collaborative custody and one entity is holding one key, you can keep one key in one country and one key in another country. And so it's just harder. Like you for example could purposely destroy one of your keys if that country's being an issue, and now you have 2 of 2 multi-sig and one key is international, right? And with 3 of 5, obviously you have even more setup options to do things like that. So there's a whole kind of, it's almost like programming, but basically there's a whole like customizable option depending on how bulletproof you want your setup to be. One thing I point out to gold enthusiasts is like I live part of the year in Egypt and part of the year in the United States, and when I'm in one country, the other country, any gold I have is like stuck in the other country. I don't bring my gold around with me. But with something like multisig, I can bring some portion of my Bitcoin with me wherever I go. I can access it basically in multiple jurisdictions safely, by having multi-signature types of setups. That's just one example use case. And so it kind of extends the portability of Bitcoin in addition to extending the security of Bitcoin.
As more companies and enterprises adopt Bitcoin, similar to like MicroStrategy, I guess you would have the opinion that they'll buy actual Bitcoin rather than the ETF or ETFs.
I think often the case, yeah, they'll generally be more prone to going to Fidelity directly or going to, Coinbase, institutional directly and buying them. Um, Maybe smaller ones will just buy the ETF. It kind of makes that a little simpler. In general, I think fund managers are a bigger target for Bitcoin purchases than corporations because corporations, they a lot more focuses on profitability, less so their balance sheet. That's partially because of the system we're in. That basically no balance sheet asset keeps up with basically the cost of equity or currency debasement per se. So that could change in the future, but that's a really long term thing. I think so far, small businesses have been far more prone to put Bitcoin on their balance sheet because it only takes the decision of a handful of people, maybe one owner, maybe a small group of owners. They can just make that decision, whereas corporations are usually very widely distributed. In MicroStrategy's case, Michael Saylor has a very large percentage of the voting rights, and he's the founder of the company. So it's kind of more like a small business in a big public forum. That's kind of a special case, but most of them are not like that. And so overall, I think that corporations are some of them will probably accumulate Bitcoin, but I'm not really seeing the major demand source for that in the next cycle. I think that funds are a much bigger deal because it's far more likely that, a $100 billion pool of capital decides, yeah, maybe 1% in Bitcoin makes sense, more so than a corporation deciding, let's put 5% of our balance sheet in Bitcoin because it's not that much kind of balance sheet capacity in corporations to begin with. And the decisions for it are way more complex compared to much larger balance sheets in the investing world. And it's normal for them to put a small percentage into something. So I think that that's kind of the lower hanging fruit overall.
Yeah, I mean, when MicroStrategy first adopted Bitcoin, it felt like there was going to be a wave of corporations adopting Bitcoin, and obviously that just did not happen whatsoever. I guess to some extent, it kind of shows how rare Michael Saylor is and the unique situation that MicroStrategy was in with him at the you know leading the company.
Yeah, I agree. I mean, you saw it from Square, we saw it from MicroStrategy, we saw it from Tesla, although he kind of flip-flopped on it. Um, and so obviously it was smaller businesses, but a lot of it's in the smaller business, the smaller private businesses. And so I think that investment managers are a way easier and larger kind of area for that is more likely to get into Bitcoin in some way that is relevant for Bitcoin price, let's say.
So now we're about 2 months until the 2024 Bitcoin halving. From your perspective, how big of an impact does the halving have on the price of Bitcoin?
So I think it's oversold in the near term. Like, there's no strong correlation between the halving and, say, 3-month price action. Sometimes the bull market's already underway before the halving starts. Sometimes the bull market happens after the halving. Um, it's a fairly small percentage of volume overall, and changes in demand can matter a lot more. Where I think the halving really matters is actually over the longer term. Obviously, if Bitcoin did not get more disinflation over time, the price would be much lower. If there were still 50 coins coming out per block, that would be huge. You'd have to have a much lower price in order to absorb the amount of issuance coming. And so it's certainly relevant. And I think the main thing is actually the higher lows in each bear market, the halving is really important for that because at a time when there's no new marginal demand for Bitcoin, there's some buyers getting out of Bitcoin. The fact that hodlers can basically absorb the supply as the price gets cheaper, they can buy more coins, and now there's fewer coins coming to market than there were in the prior cycles. That's really relevant for having a higher price floor in bear markets. And so I think overall the timing is overdone in terms of narrative, but then obviously the importance is still really there. And I think this is still to some extent affects the timing to a moderate degree. I just think that overall global liquidity indicators tend to be more correlated with Bitcoin price, which makes sense because, the halving determines, a couple $1 billion worth of annual issuance at current prices, whereas changes in demand can affect hundreds of billions of dollars going in or not going in a given year, for example. And so I think that's a much bigger factor for timing, but I think the halving is a really important one, it's important for narrative, and two, it's important for the higher highs and higher lows in each cycle.
Yeah. Where are we in the liquidity cycle? Are we about to potentially see like the halving happen at one time and pretty much the liquidity cycle also be very, dovish per se at the same time?
So the liquidity cycle looks actually a lot like the Bitcoin price chart, which is basically that the liquidity cycle is off of its lows. So by most measures of global liquidity, the low was in late 2022, a little bit before the Bitcoin price.
In this frontier moment, Lynn is explaining the correlation between Bitcoin's price and global liquidity trends, highlighting the synchronization of Bitcoin cycles with global M2 money supply growth. Here, if you're watching this on video, you can see the historical Bitcoin cycle peaks and troughs align very closely with global M2 growth. For those just listening, Bitcoin bottomed around $200 in 2015. At the same time, year over year growth in global M2 was 0% or slightly negative. Later, Bitcoin peaked at roughly $20,000 per coin at the end of 2017, around when global M2 growth also peaked at just over 15%. This correlation has occurred every cycle since. This challenges the prevailing narrative that Bitcoin's halvings are the key drivers of its bull markets. While halvings may influence Bitcoin's price, the broader context of global M2 growth can't really be overlooked. With global M2 growth showing signs of acceleration and the 2024 halving on the horizon, the stage is set for another potential bull market. However, the exact catalyst, whether it be halvings or liquidity shifts, may likely remain an unsettled debate. And now back to Lynn.
Low, um, and it's turned up from there, but it's been more of like a consolidation. So it's not really broken out to new highs in liquidity, but it's looking decent overall. And I think when you look over the next 2 years, liquidity is probably gonna go up, which I expect to happen at Bitcoin price as well. And so overall, a lot of it looks like the Bitcoin price chart, which is it's more of in a consolidation phase. It's certainly in a kind of a bull crab is I've seen some analysts talk about that, like, I think Jeff Ross, and others have mentioned that basically like a crab, bull market's up, bear markets are down, crab markets are sideways. And a lot of things are kind of in a bull crab, like you're not soaring, you're kinda going sideways to up, and I think we're seeing that in liquidity, we're seeing that in Bitcoin price, where you're not at new all-time highs, you're not at price discovery, you're not at, just soaring liquidity, but it's way better than it was, in late 2022 and still generally going in the right direction.
When it comes to pricing Bitcoin and like various models that have been passed around, like do you find the stock to flow model valid? Do you find like the power law model valid or useful at all? Or do you think that none of these models are really valid and useful?
So I don't like price models for any given cycle or 2. Like in some of my early articles, I would, for example, show a graphic of the stock to flow model just because it's one of the early charts that showed it in log form. But then even then, I would say I don't know if this price is I don't know about the price itself per se. Um, I think basically where a lot of this comes from is that Bitcoin's on an exponential curve, but then it has boom bust cycles associated with liquidity, associated with the halving, associated with all sorts of things like that. So if you any sort of price model that is exponential with boom busts along the way is gonna look somewhat like what it's doing. But I don't think we get much informational value to say how much higher is this cycle gonna be than the prior cycle? Um, I don't really know, right? So I don't really try to do these like specific price calls, or these specific, Bitcoin should be this price by this date because, for example, things like the ETFs or not having ETF matters. Improvements in UX that enable these Bitcoin communities around the world that I talked about, right? The coming or not coming, those things matter in any given cycle for price. And so I think there's a lot more than just modeling out a price, but other than to say that I think exponential with boom bust is roughly what we're probably going to continue seeing.
Yeah. If we do if we are heading into another bull market, is there not necessarily a price, I guess, but is there like a moment or a sign or like a signal that's going to be like, hey, this market is way overheated right now and Bitcoin's probably about to go into another like 70% correction? Like, what do you think that might be this cycle?
Well, so one of the pictures in your background, like the hodl wave type of chart, I pay attention to that. If you see a lot of longer term held coins coming to market, um, basically, if the price goes up enough, the supply gets a lot more readily available. That can start marking the not maybe not the top of a cycle because it's hard to say where this kind of hits its crescendo, but the risk reward in any given 2-year period starts to get materially worse when that ratio is going down a lot. It's already gone down a lot. A lot of new coins are entering the market. There's a mania. In the last cycle, like when I saw things like Dogecoin going vertical, when just like when just there's kind of just mania everywhere. Um, because what happens is, Bitcoin is obviously fixed supply and there's lots of demand coming in. But when that demand starts to get very not focused, and when there's all sorts of supply that starts popping up to meet that demand, whether it's like I said, the older coins unlocking and saying, "Hey, you want my coin for $250,000? It's yours," right? Like that, as more coins kind of come to market, as people say, "Well, what else can I buy? I want to buy this coin. I want to buy this coin. I want to buy this JPEG. I want to buy this thing. I want to invest in this overvalued equity building on blockchain XYZ," right? All of that is meeting demand. And there's infinite amount of supply of random stuff that can keep coming to market to meet that demand. And so you start to get closer and closer to the risk of saturating demand for that cycle. And then you have like a bust where people get disillusioned. They bought at the top. It's kind of late money bought at the top, and then you go through kind of a shakeout cycle to get rid of all that excess. And so really that combination of seeing the HODL wave go down or other measures of kind of tightly held coins coming to market, combined with just a flurry of other low quality things trying to meet the overall demand for capital that wants to enter the space and is maybe not that differentiated between Bitcoin and other things that are happening.
Do you think we'll ever see a bull market where there isn't that much interest in crypto more broadly or like meme tokens or meme stocks in general? Or will blow off tops or like massive bull markets typically always end with, a flutter of other random nonsense garbage?
I mean, I think that you can hit a peak. Like, I think the ratio of that relative to Bitcoin can hit a peak and descend over time. Maybe we saw in the past cycle, maybe we didn't. We'll find out in this cycle. Um, but yeah, I think that to the extent that Bitcoin still has some major cycles ahead of it, I think it's going to come with other things along the way. But I think that ratio is important. Like, how big is that other stuff? Like equaling the size of Bitcoin, or is it half the size of Bitcoin, or is it a third of the size of Bitcoin? That ratio really matters, right? So, in the last cycle, it's like you had tens of billions of dollars of VC capital flowing to crypto projects. Um, you had kind of peak like FTX with like celebrities, major Super Bowl ads like that might have been the biggest cycle relative to Bitcoin. Maybe that's famous last words. Maybe this next cycle gets even sillier. But the fact that that also coincided with the meme stocks and like the post-COVID like liquidity coming to market, that's a pretty hard mix to replicate again. So maybe that was the biggest crescendo. But yeah, I still think we're going to see more ahead. The ETFs also make it so that capital can flow into Bitcoin more easily than it can necessarily flow into the altcoin space as easily. So there are a couple of things that are different going forward, at least for a period of time. So I think it'll be associated with altcoins, but maybe a little less so. But if anything, what we're seeing early on in the cycle is that there's mania around Bitcoin L2s, right? So a lot of that stuff, instead of being next to Bitcoin, some of that's gonna be on top of Bitcoin. It's hard to say what ratio, but we're already seeing some of that on top of Bitcoin, and I think a big capital raising narrative will be, "Hey, we're building Bitcoin layer 2 using this new technology," and I think that's probably gonna be a narrative point this cycle.
Yeah, I agree with that, especially if fees really start to rise. People are going to demand some new scaling solutions and be willing to invest
Yeah.
in them. I do want to talk about ego death. And I want to get your perspective on, buying Bitcoin versus buying early stage Bitcoin companies. How do you think about those two ideas?
Yeah, it's just a question. I mean, I think that the kind of the starting point is just buy Bitcoin. I think like I wouldn't invest in equity of companies before I own Bitcoin. I think Bitcoin is just the simpler move there. So for people that are not familiar, I'm a partner at Ego Death Capital. We do Bitcoin focused venture capital to try to build out some of these either scaling solutions or just companies that are making Bitcoin better in some way. They're bringing Bitcoin with new UX. They're enabling other solutions with Bitcoin. It makes sense that as this ecosystem grows, there's companies that are on top of it, trying to enhance part of it or make it more accessible to people or do something with it. Um, and so the general theme is that if you're successful in that, like some of the best performing companies on Bitcoin should outperform Bitcoin because not only are you benefiting from the growth of Bitcoin, you're gaining some market share in Bitcoin itself or in the surrounding ecosystem of Bitcoin. And so the best ideas should probably outperform Bitcoin, whereas the long tail of not so great ideas and not so great execution is going to underperform Bitcoin, which is why I think it makes sense to start with a Bitcoin allocation. There are some pools of capital that just by their nature can invest in Bitcoin. And they can invest in equity. They can invest in private equity. They can invest in venture equity. And so one of the things we saw in the past cycle is making Bitcoin accessible to entities that like Bitcoin but can't buy Bitcoin. And so, for example, um, if you're a mutual fund manager for stocks and you like Bitcoin, but your day job is to manage a stock portfolio and you want to perform very well, and then you see Bitcoin miners or you see MicroStrategy hold Bitcoin, you say, okay, well, there's no Bitcoin ETF. Even if there was, my job is to pick stocks for this fund. But I want to express a bullish Bitcoin view. I can buy MicroStrategy or miners. That's been a thing, and it's gonna continue to be a thing. Um, and so there are banks, there are large funds, there are pensions, there are high net worth individuals. There's all sorts of things to say this is our allocation to venture. And if someone is interested in Bitcoin, I'd much rather have that capital go into a Bitcoin space than an altcoin space. So I think that there are different types of capital out there that have different needs. So I don't necessarily compare them one to one. But I do think that, yeah, if you're comparing on a risk adjusted basis, one, I would just start with Bitcoin. But then two, if you're interested in one, learning about the space more, helping build out the space, or three, want to potentially have venture returns on top of a venture like asset, that's where the Bitcoin equity space can.
Are there any like company ideas or themes that you're most optimistic about when it comes to like the early stage Bitcoin startup space?
Well, so overall, I like utility more than speculation. Speculation's a thing, it's always gonna be a thing, but at the end of the day, I wanna try to solve problems or help others solve problems, and I think basically making Bitcoin as good of a money as it can be, is a key thing. So anything that makes custody better, privacy better, um, that makes liquidity better, that kind of stuff appeals to me. So, for example, an area that I've liked a lot recently is Chalmy and eCash. And that could be the Fedimint protocol, that could be the Cashew protocol, that could be companies that are building on top of either of those protocols. Um, and so that's an area that I like. And if anything, a recent thing we've seen in Lightning and Bitcoin generally is because fees are higher now because of these other uses of the blockchain mostly. But in the future, we'd expect that if Bitcoin is very popular, fees, even just for the monetary use, are probably gonna be pretty high. And a lot of people are surprised by that. They've been holding like $25 UTXOs on chain, or they're surprised when it costs more than almost a trivial amount to open or close a Lightning channel. Whereas there's a lot of people that understood these scaling challenges ahead of time, that these are all like scaling solutions, but they're not the end thing for every purpose. And so one of the first investment we did in Ego Death was in a company that's using Chalmy and eCash to further scale things like Lightning and Bitcoin more broadly. And it makes use of the fact that Lightning exists, right? So um, a lot of these Chalmy and eCash protocols, whether it's Cashew, whether it's Fedimint, they're enabled by Lightning. They extend Lightning. Um, and they allow more people to share a Lightning channel or to share on-chain UTXOs in a way that's more private and more localized than trusting giant international entities like, say, Binance, for example. Um, and so that's the type of thing I try to focus on is things that are solving a problem, things that say, hey, more people around the world want to have good money, use good money, they want to have good UX, they want to be more private. Um, that's the type of stuff that really appeals to me and a lot of other people on our team.
Yeah, I like that a lot. If there's one reason that you think Bitcoin could potentially fail in the near future or distant future, what would it be in your view?
So I think a lot of people in the space don't necessarily pay attention to the technical risk, to the way that they should. And that's also why I don't view Bitcoin as risk free or recommend like 100% allocations to it because, I mean, you get a very different picture when you talk to developers than when you talk to people that are less technical, right? And to some extent, it's their job to worry. We should be worried if they're not worried. Is a good way to look at it. But there's a lot of complexity under the hood. And that's also going back to one of our earliest points we talked about in this discussion, the importance of keeping Bitcoin simple because it reduces the number of things that can go wrong. So, in 2018, there was an unintended inflation bug that was fixed before it was exploited. You can imagine a scenario where that was exploited before it was fixed. And maybe that doesn't kill Bitcoin, but maybe that sets Bitcoin back 10 years. Maybe that damages the reputation of Bitcoin um, so thoroughly, even among some long-term proponents of it that say, "Well, I don't really trust Bitcoin code anymore," for example, or how do I, that in some ways it's an anti-fragile system, but that's only up to the point. It's like what doesn't kill you makes you stronger, but you still have to make sure you don't get killed, right? A bullet to the head does not make you stronger. And so I think that there are still tail risks associated with Bitcoin code that should be taken seriously. Um, and that you want to make sure you have plenty of developers looking at the code, reviewing the code before every updates, that are being very conservative with updates that they make. Um, and that people are kind of purposely slow to update to make sure that, you know, they're not just jumping into either just new normal upgrades or flashy new things. And so underneath the surface, there is still technical complexity, even though we want to minimize it as much as possible. As users, the developers want to keep it as simple as possible, robust as possible. But that's still something that has to be considered. And that's different than, say, gold, for example. Gold, you have gold in your house, it's not going anywhere. Um, Whereas Bitcoin relies on the internet, it relies on the underlying code working, it relies on a handful of things that continue to go well. So it's in some ways it's a more aspirational technology, it's a more optimistic technology, and that does come with certain risks along the way.
Yeah, great points. Lynn, thanks so much for taking the time to do this. Where can the audience go to learn more about maybe your book or wherever you want to send them?
Yeah, so they should check out Broken Money on Amazon. If they want to go down that route, they can also check out lynalden.com from my public and private research, and Ego Death Capital if they are interested in investing or looking into the Bitcoin venture space.
Awesome. I love it. Well, thanks, Lynn.